Drew, buy, hold, sell, Kelly Partners.
Kelly Partners, the diversified accounting firm.
Yeah, you could call it diversified.
Accounting and financial planning. What's the current price? I mean, there is
get the candlesticks up.
There is a lot happening in large scale financial services at the moment.
Yeah. Do you reckon? Yeah. Would you buy an accounting firm?
Probably not.
No?
They are difficult businesses to run, and probably depends on what the exit is, doesn't it?
Yeah.
That is it. Accounting firm generally trade on I don't know, historically a 1x revenue or thereabouts. And that's why a lot of accountants end up going to financial planning, because financial planning offers a
bit more sticky
revenue multiple. Yeah. What's happened today? Something new?
Completion of partnership with Irish accounting business. This was an update from March. Kudos International, fastest growing global network.
I thought there was a list of call codes. Or is that all their partnerships?
This is a bunch of the different firms that are available in the world. I don't know. I feel like there's a lot of accounting to be done in Australia rather than going overseas, Drew.
Yeah, and it's it's like watching Xero trying to expand into the US.
Yeah,
like the tax laws are very different in different places.
Yeah.
Same rules don't always apply. Up 46% this year, though.
What, Xero or Kelly Partners?
Kelly Partners.
So here we go. This lovely chart they got here. There's 28 practices in Australia, 1 in Hong Kong, India, United Kingdom coming soon, and 7 in the United States. Good holiday destination.
History, mission, values.
I don't know. But we had Brett Kelly, found a very impressive individual on the show not too long ago.
It's a solid business worth $500 million.
I guess the question that we've got here is from someone that wrote in, just quickly. They were diplomatic about it. Rowan Rask.
I
think they're back again. This is like a repeat offender. They've written in and said, a company just issued a share placement without previous announcements or prior shareholder approval in a private placement, Drew. They cited section 6D.2 of the Corporations Act. We love that section. How can they do this without shareholder approval and dilute said shareholders? Mildly enjoy the potty on the odd occasion.
Is that a compliment, or is that what they call a compliment sandwich?
Compliment sandwich, indeed.
A poo emoji sandwich.
My understanding is that a company can issue some shares up to a limit without shareholder approval.
That is right. You probably check on Gemini. No, I'm just joking. You can't rely on AI for everything. But there is I think it's under listing rules and under company, it's mainly under listing rules because that's where it really matters. There are I think it's very tight. It's a couple of percent, if that, to issue shares to an individual company or without going to a vote. But I think as it gets bigger and larger, it has to go more publicly, and that's where you get the entitlement offers and the even within entitlement offers, you can have you also have direct placements in some cases, don't you?
Yeah.
Where you guarantee a capital raising, and then you have a placement, an entitlement offer that goes to the rest of shareholders.
Why would... Yeah, but this announcement, it's from the 30th of June. I'll read it verbatim so I don't get myself in that much trouble. The company advises that, 1, it has issued 374,957 ordinary shares on June 27, 2025, without disclosure to investors under Part 6D.2 of and it goes on. But it doesn't actually... How much is $370,000 shares worth? They're $11 a share.
Ooh.
I don't know. Quick math. That's a lot. Or is it only $3 million? Let me just do some quick math.
It's probably only $3 million. $11 a share. 300. How many shares? 367,000
We're in
shares.
finance. Yeah.
Just go back to Gemini.
So it's $4 million.
Yeah. You might have overstated that a little bit. So
okay. It's like
less
600
than
mil.
Less than 1. We're not talking about shares in Apple or Tesla.
No, so the market cap's 500 mil here according to the TIKR Terminal. TIKR Terminal, new sponsor of the show, Drew. Be very kind.
Yes, of course. I've got my own login.
Do you really?
Yeah, already had it before the marketing started.
TIKR is actually, it's freaking awesome. This new valuation builder, which we can go through another time, is something else.
Part
anyway,
6D.2 of the Corporations Act regulates the disclosure of information to investors when offering securities for issue or sale. It outlines when disclosure is required.
But shouldn't it actually just say, wouldn't you expect the company that you own shares in
not required.
Like, I think this is fair enough. I'm not like picking a fight here. But wouldn't it be fair enough that if you give $4 million worth of shares to someone, that you tell the other shareholders who got the shares?
Yeah.
Like,
you can find it out, can't you? If you go to the can you apply to the company secretary to get a share, or they only have to give the top 20 shareholders?
maybe they did say this. Let's just have a look at these other notices. I just feel like that's not
under what rule did they apply?
They've got the ASX release. And sorry, this is not good podcasting content, but
welcome to this week's episode.
But we have had a lot of people write in about Kelly Partners over the years, and I don't really know what is going on. So I don't know. I just feel like if you do issue that amount of shares, you should probably say who they go to.
Is it one of the partnerships? Is that why? Is that required to a particular?
Anyway, I just think that that's probably like, it would probably be, if you're a shareholder of Kelly Partners, it'd probably be a valid question to ask, like who got the shares? Because it doesn't seem to me, I don't know. I like the honest, frank disclosure. Let's put it that way. So that's not really what's making news this week. Soul Patts has secured financing as expected, probably from itself. It's a great business, doing a bit of a big wheel and deal over there at Soul Patts with Brickworks. What else is making news? We're recording this on the 8th of July, Tuesday.
Big news coming that would have come earlier this week when you're listening to this.
Yes, time lapse.
And it was clear that it's clear now.
You could wait.
How far ahead?
So we're recording this 2 hours before interest rate decision is made. So we could record two versions of this same
episode and see what happens. Yep.
And we could be right either way.
50 basis point cut.
Well, according to the RBA rate tracker, it looks like the implied yield, Drew,
25.
It's at least 20 today. It's priced in. So 25. Any more than 20, they're saying 50 by next month though. So
remember my pseudonym, my alter ego,
Dr. Andrew Dermott. How could we forget?
The thing about this is I was calling interest rate cuts, and if I had just kept saying it for another 18 months, I would have been right.
Yeah,
even though it went up example
11 times, like it still went down eventually.
Point. Exactly.
So rates are forecast to hit 3%, the official interest rate.
When?
By the end of the year, basically.
Yes. I mean, and we know these change every day. I think this is one of the things that happens in the financial media is that someone will say, "Oh, the market's predicting the cash rate will fall by 3% today." It can actually change. If something happens more with tariffs, as we saw overnight, or if something happens with the economy tomorrow, then rate expectations will change again. I just started. I don't know this. Once I saw we had a rate decision tomorrow, I'm like, "Oh, where's everyone else's rates around the world?
Yeah,
like where do we sit?" Trump's writing handwritten notes on handkerchiefs to Jerome Powell, chairman of the Federal Reserve. So I was like, where does everyone else? So we're down 4.35 to 3.85.
Not far.
We've dropped 50 bips.
Yep.
Seems like, maybe Elbow should be sending a letter to Michelle Bullock at the moment, or me, either way.
Yeah.
But the US, how far, do you know how far they've dropped?
Well, I've got your notes right in front of me.
Oh, damn it. Yeah. So really stitched myself up on this one.
Yeah, so US 5.5 to 4.5 for everyone playing in high.
Full 1%. That's a 50 basis point. I think they started with a 50 and they've done 2 25s. But probably most surprisingly, the UK have done the same. They seem to be struggling more than, although the consumer is starting to recover in a lot of these economies as we go through our quarterly reviews. Europe, this was a surprising one. So they peaked at 4.5%, around the same level as Australia, or slightly higher, and they're already down to 2.1% cash rate.
Wow.
That's a halving in what are otherwise seemingly benign conditions.
Yeah.
So are we behind the 8 ball? Do you think Australia and the RBA needs to cut more aggressively? Are we ignoring? We've got a tendency in the GFC, we increased interest rates once the GFC hit. Yeah. Or once the initial part started to hit.
But there's a real big difference between those debt markets in Australia, but also secondly is a lot of people will be familiar that in the US, they have 30-year mortgages.
Yeah.
So in Australia, if you increase interest rates, you have basically immediate, like in the next 2 years, there'll be a flow through.
Everyone gets a hit. Yeah.
But if you're smart in the United States, you just get like a 30-year mortgage and you just never leave your house.
Never refinance.
Yeah. Like some people in the US would have locked in for 25 years, their mortgage at like 2%.
Yeah.
So imagine like Doesn't matter what
never
the
leave.
RBA,
And it doesn't carry to
central
your
bank
next
does.
house, so that's the only problem, isn't it?
Yeah. Are bank stocks overvalued?
No.
Okay.
Yep. Still happy with CBA.
Speaking of,
It's having a bit of reversing a little bit at the moment. But
reversal.
yeah,
They say the money's washing out of CBA and into BHP. Is that true or false?
false. Okay. I mean, there's always some washing about. CBA, I mean, naturally, you're going to have some sell-off in, when something's gone up 45% for a year.
Yeah.
There's always going to be a little bit of sell-off. And then iron ore, BHP, iron ore, that's a completely different story. It's people repositioning, having not held mining companies for a while.
The Dizzy Rascals community portfolio, if you are playing, if this is your first time here on the Australian Investors Podcast, 2 Cents Saturday morning show.
We're in trouble.
We ran 3 portfolios. We created 3 portfolios at the beginning of the year with fake $10,000. Navar, who's the founder of Navexa, has assured me that it's not real money, which is a bit disappointing, but...
Maybe 3% up. $300 will buy you one of your favorite bottles of wine.
I go for I'm in the cheap seats, mate. Bit of Radio Bocker, actually. Love that. Yeah. Anyway, so.
Some Cobram State olive oil. I had an update yesterday too.
Yeah, well, you never know. Get them back on the show, get some
They sent
oil.
through a delicious one, didn't they? Remember that?
Yeah. Anyway, so $10,000 portfolio. We kicked them off at the beginning of January 2025. And by the end of the year, it's the community's portfolio, which is Dizzy Rascals, versus Drew's portfolio, which is everything portfolio. And this is the best one, named by the podcast producer, Monique, here at Rask. And that's my one. The Dizzy Rascals community portfolio is up 5.3%. This is the best one, is not the best one, as per usual. Is up 3.85%. Still in the green.
Dimensional small
and
company.
Everything portfolio, the Honourable Drew Meredith, is up 4.46, which had a bit of a reversal overnight, Drew, because Tesla got absolutely smoked.
Just Elon Musk. I just want him to stay out of the news for the next 5 months, just so I can win this. All I want is bragging rights. It is the only thing. Worst pick, Vulcan or Tesla?
No, Vulcan. Vulcan has no basis as a business.
Tesla's
Sorry, that's pretty brutal, but like... No, it's got a basis.
Just don't get him calling us.
It does stuff.
There's enough happening already.
We figured out like 2 weeks ago that Vulcan has some sort of debt thing that's going on, and it's not pretty.
It doesn't make sense.
At least, I don't know. Tesla, I was saying to you off air that I would probably buy Tesla's shares right now.
Yeah. As long as he's not starting his political party.
Oh, yeah. What is it? The America Party or something?
Yeah.
Sounds like Clive Palmer 2.0.
I think it is just clearly driven by sentiment, though. If it looks like Musk is not focused on Tesla, people freak out. They sell the shares. At least the top end, anyway.
I actually, legit, if you don't get many opportunities.
Kathy's not selling.
Over the full arc of a business, that you get many opportunities to buy the world's best companies or world beaters for less than they're worth.
Yeah.
I'm not saying that Tesla's worth whatever it's worth.
30% more, yeah.
Let's actually do a quick. We can look at this. Now, for anyone that's watching, you will get this.
Tesla.
Watch this thing. So one of the reasons why I think TIKR wanted to become a sponsor of the show is so we could show people this new tool that they've got. But you can, because it's got this whole thing coming, but this AI tool, and not even AI tool, it's just like an amazing programmatic tool. So we'll go Drew's punt. So if I go with this and I just put in a valuation of Tesla shares, Tesla, it says here, over the past 10 years has grown at 39% per annum its revenue.
Ooh.
So then you pick an amount.
Revenue.
What do you reckon?
It's naturally going to drop. Let's say
3 years is 22%.
33%.
So you think it's going to go 33% per annum revenue? It's a fucking... Excuse my French, it's a huge business.
1%, 22% in the last 3 years. Let's say 18.
Okay, 18%. That's your forecast, Drew, for the next few years through to 2028. Its operating margins, historically, obviously it was scaling up. It's about 10%. BYD is 5%. So EBIT margins were 7.2% of the last 12 months. What do you think? EBIT margin?
8.
By 2028, average. 8. So 8% EBIT margin. Yeah. What do you think the price earnings multiple will be when you sell the stock in 2027? And here we go. Over the last year, it's averaged 110. Over 5 years, it's averaged 95 times price earnings ratio. Over 15 years, it's averaged 69 times price earnings multiple. What do you think?
7. I mean, what's fair?
I reckon 20.
20?
I reckon it will sell for 20 times earnings if it grows.
Yeah, but that's just going to drop my valuation at the other end.
No, the higher valuations are better.
Yeah, higher multiples.
Yeah.
Yeah, you want 100. I'm going to sell it at 100.
Oh, so you're thinking 100. So because you want to go up. Make this thing go up.
You're trying to tell a story about don't touch Tesla.
I'm trying to tell a story and be reasonable.
What's realistic? Maybe like 40?
Okay, let's go 40. Yeah. 40 times earnings multiple in 2028, 8% average EBIT margin,
valuing
18%
Amazon on earnings in 2002.
It is severely overvalued. Target price $150
versus change that multiple to the same multiple that it has today.
Same multiple. Go back. So what's the multiple today?
100.
So if you're saying 100 times is what Tesla trades for in a couple of years, generate results. Yeah, it's actually decent.
Fairly valued.
Yeah, fairly valued.
Just has to trade on 100 times.
So if you were going to sell Tesla, according to this simple valuation tool, which is really cool, it would have to trade at 100 times earnings in 2028.
Or its earnings would have to have significantly increased ahead of what is currently predicted. Ahead of that expectation.
I reckon, yeah. I don't really use the valuation tail to wag this dog.
It's a momentum play.
I think that Tesla's actually, there's potential in Tesla's business. It's not a core holding of anyone's description, but I actually think it could be worth this very small allocation.
I mean, there's a reason Kathy Wood loves it. Like, there's potential step change in Tesla. That's what she talks about. That's what happened in Apple, where the software is more important than the production of cars. We all focus on the production of cars and the margins on that, but the controlling software, the autonomous vehicles, how far ahead most of the other projects are, that just completely changes it. That turns your revenue to 300% growth one year, and then a completely different base. And then if your revenue's going 300 and your margins are increased, well, then you don't need 110 times PE. You can have a 50 times PE or a 40 or a 30.
Yeah.
And the company's bigger, like NVIDIA.
100%.
That's what people are looking for. And that's the kind of...
So according to your theory then, if Tesla's trading at 100 times earnings, it could actually be good value. If it's trading at 120 times earnings,
could be good value.
Undervalued.
Yep.
That could be
no one ever.
Yeah.
I mean, it's kind of... This is the challenge of value and growth investing, isn't it? Because everything about growth investing would tell you can't buy a company that's on 100 times PE, but you have to know more about the company to make that decision. And everything would tell you that buy something with a low PE and you'll do well. And I can't see how that's worked significantly over a long period of time for the last 15 years.
I don't buy that at all anymore.
Yeah.
And not just like
Are you a GARP?
Growth at a reasonable price. I think that's a pretty good ETF. Global Access, that sponsor of the show. I'd feel like... Yeah, I would say if you define, would you define Warren Buffett's investing style as GARP? Like American Express, Apple?
It was originally value, and then he transitioned. That's the more important thing, and I think I did turn into GARP.
Yeah.
Opportunistic GARP.
Well, if that's your version of GARP, then I'm definitely GARP.
Everyone sees him as his value investor, which he was when Graham was.
Yeah.
But hasn't been for any time since.
All right. I'm going to do a bit of pop trivia with you because you always give me over or under. No, I don't know how to do that. What are Warren Buffett's 3 biggest shareholdings right now?
Listed shareholdings.
Yeah.
Apple. He's been selling it.
Okay. What else you got for me?
Is this still Coca-Cola?
Don't look at the screen, but go on.
Campbell Soup's private, isn't it?
Yes. So you got Apple.
Yeah.
Coca-Cola. And what's the third one?
Microsoft.
No. Apple, you were dead on with that one.
Oh, Amex.
American Express is number 2 and Coca-Cola is number 3. Then we've got Bank of America, Chevron, Occidental, Moody's, which he got in like the 90s. He got that in the 90s, I think. He bought American Express in like 1992 or something.
I mean, I love this. This is like, everyone should go buy an index fund. But I've got 23% of my holding in Apple. I've got half my business in private capital that runs an insurance company. I own electricity networks. I own
Japanese
railroads,
stuff.
some Japanese conglomerates.
Visa.
But go buy an index fund. Only. I'm not just buy only an index fund.
But that's because not everyone is him, I guess.
You don't have to just be him to be able to build.
Yeah, I know. For what it's worth, I agree. I'm just playing devil's advocate.
It's more the fact that everyone takes it as being only. It's like basically don't buy anything but one index fund.
Yeah. Yeah. 100%. The simplest advice when you've got 100 million people that follow you is the one that is the least amount of risk for that 100 million people.
Yeah.
It's like us here on the podcast. We've got to say things that maybe we wouldn't say if it was just a bit of a chit chat on the weekend. Well, I guess this is a bit of a chit chat on the weekend. Punted all on Tesla. Yeah. I just, I find that really fascinating that if you look at Apple, American Express, Coca-Cola, Bank of America, which is a massive bank, Chevron, Occidental, Moody's, Kraft, Chubb.
You can say that's bullish for Commonwealth Bank, given Bank of America is a consumer bank.
I reckon if you look at that, that's 100% GARP. That's not value plays.
Yeah, would Buffett own CBA?
I think he would.
Yeah.
Because he's got Bank of America. He used to have Wells Fargo. So I reckon he would. I don't know if he'd pay today's price. He might wait a little bit, but I reckon he would.
He loves brand and he loves moats, economic moats.
Yeah, well, he did that deal with Insurance Australia Group. IAG is the ticker symbol for folks.
Yeah.
So, yeah, I think he's a GARP investor, like a growth at a reasonable price. I think that people spend too much time focusing on how he would value a company and not enough on the qualitative
I don't know
aspect.
you get this on TIKR either.
Oh, you can do heaps, man.
It used to be like guru focused. Remember that?
Yeah.
Yeah, you have to go in there and get all the spam to see any of this stuff.
Yeah, you see it all here. Crypto, buy, hold, sell.
Well, according to what I was reading this week, you have to buy it. It's like the, this is not a recommendation. There was a couple of articles on, I think it was on Bloomberg. I think it was more broadly on the Fin, which was talking about this relentless bid that's come into crypto markets. And now that ETFs exist, they become investable.
Yep. So
like a lot of big fund managers are adding, and I spoke to our investment committee about it this week. Actually like half an hour ago. And as would they add crypto to a portfolio? Because you only need 0.25 or 0.5% of a portfolio in an asset class like that for it to have a potential impact, and you're also not necessarily putting up too much at risk. And until ETFs were broadly available, it was a clear no. It was far too difficult. The custody, all those sort of things were far too complex, and they didn't flat out say no. So I was interested to hear that. But they're talking about there's just more and more companies in the US, including the ETFs in Australia, that are just announcing that they're buying crypto as a hedge, and they're holding crypto on their balance sheet. Bitcoin in particular, I think it's Ethereum, Ripple, maybe a couple of others. And that's just seeing this, and some of the only ways they can buy it is through an ETF. So you're seeing this relentless bid in ETFs at the moment. I don't hold any myself. Never have. That's what we're seeing. Probably haven't spent enough time on it.
But that's what we're seeing with CBA and all the big blue chips. Yeah. So money's just pouring into these stocks.
The ETF.
Because the ETF flows and the superannuation funds. We talked about it like a couple of weeks ago.
Yeah.
Have you seen this company?
MicroStrategy. Yes. I had no idea what these did, and there was another one.
Don't worry about that. It just buys Bitcoin.
Yeah, that's what I thought. Square? There's another one called Square that listed recently. No. Is it Square?
No, Circle.
Circle, which is like a community platform, but not that Circle. Not that one. The other Circle.
Yeah.
Which is the one that does, do you use Circle?
Yeah, we use Circle.
Yeah, not that one. The Circle was an IPO that basically just owns crypto.
Yeah. When I saw that Circle was listing on the New York Stock Exchange, I think it's the New York Stock Exchange, I was like, well, how much is this worth? Thinking, because this is for anyone that's in the Rask community, you will know that we use the Circle platform to deliver our community. And I was like, how much is an internet-based community thing worth? Well, that's not this Circle.
Yeah, it's a completely different one. It popped like 70% on the day. I'm like, did you get equity in that?
Circle operates a platform network and market infrastructure for stablecoin and blockchain applications.
What does that mean?
Yeah, stuff. $43 billion US is what it's worth. I don't know. I don't want to say that I know that much about it because I don't, but I think it's mainly the bridge between a fiat currency and your cryptocurrency. So I think...
And like a transfer payment
provides
network,
a suite of stable coins and related products that include a network utility and application platforms to benefit from stable coins and the internet financial system, and issues a US dollar denominated stable coin. Yeah, there you go. Okay. So that's basically what it is. I don't own any crypto other than what I can't get into through my app.
Yeah.
That I no longer have the phrase for. It's probably worth a bit now.
$48 million.
Do you own any?
No, I tried to set up an account when they sponsored all the football clubs and they gave you kind of free accounts. But then when I started looking at it, it was just I don't understand enough. Usually I'd have go deep and try to get some kind of knowledge. Maybe I could use ChatGPT to do that now.
Yeah.
But no crypto.
No crypto.
A few clients have been interested, and we've used ETFs to help them as an execution only kind of idea.
Yep.
But not something that's central to what we do in retirement anyway.
Yeah.
Maybe that'll change.
Yeah, fair enough. Yeah, I don't own any of this. Like, I can understand how some of these things, like Robinhood came out in the last week and did a tokenized investment platform. So basically using blockchain to help people invest.
Yeah.
Some really interesting things around this, but it makes sense. We've talked about this, I think, a few times over the years, that you could have a blockchain that is the stock market rather than the ASX or the NASDAQ or something. Whether or not it takes off, I think that one of the things that happens with this sort of thing, Drew, is you've got to solve a problem.
Yeah.
And if there's no real problem with the existing infrastructure,
It's a little bit inefficient. Yeah.
it's not going to grow as fast as people think. But maybe I think that we will have, I think there's a version of our future in the next, say, 10 years from now where private companies change hands on a blockchain.
Yeah.
Which would make sense. If you think about it, imagine you go and try and buy Bob's Mechanics down the road. At the moment, he's got to go see a broker. They've got to read the shareholders agreement. They've got to figure out if there's any debts attached to that thing. They've got to figure out how many shares are out there, who owns the shares. Wouldn't it just be easier if there was a thing that...
Here's the shares.
Yeah. Here are the shares,
Here's the last
trade it
trade
on
in.
exchange, convert it into digital currency. I've sold. That would be an amazing experience. And I think that is what will come for the private markets. I just don't know who's going to do it and when. Origin Energy. What's that about?
Oh, yes. There was big news on Origin Energy this week. Sorry. It actually popped quite, I mean, I love using a word like popped.
Yeah, popped.
On Monday. So Origin Energy, I had a friend who worked there a couple of years ago.
Commiserations.
Almost, I don't know if it was accidental. I mean, it was obviously on purpose. They bought it. But they had a stake in a company called Octopus Energy that quickly went from like a startup to, I think that it is now the biggest energy retailer in Britain. So Octopus Energy.
Yeah.
And Octopus own this platform called Kraken. I mean, Octopus, Kraken,
Makes sense,
the mythical.
Yeah, thing that comes up from the beneath.
Yeah, like the rum.
Yeah.
And Kraken has been taking, I think it's like a customer service and business management platform or something of that description. And they're now looking at pushing Kraken out of the business into its own entity. And that alone could be worth something like 15 billion Australian dollars.
Wow.
Yeah.
As in that company or just Origin stake?
Origin stake in Octopus could be as much as 3.5 billion.
Wow. So the whole of Origin is worth 20 billion. So that's a material stake to come out of nowhere.
Yeah.
Subsidiary of a subsidiary.
They've been increasing it reasonably, but I think the success of that has been significant.
Wow.
It's almost one of those examples where maybe, Octopus probably doesn't want to buy coal. Coal assets are rolling over, but it's super interesting if Origin's ever broken up, and there was a bid a few years ago too.
Do you know a company called Energy One on the ASX?
Not on the ASX, but I've heard of it.
I'll just bring it up in the Lord Our Saviour Google Finance.
Not TIKR?
You don't know that?
Energy One? Ooh. Oh, is this a crypto company?
No.
Oh, I thought it was going to be crypto mining.
Energy.
That would make sense.
It does software for energy producers and retailers.
Does this also own shares in Kraken?
No, but it's its own thing, right? So
shutting me down.
Yeah, unfortunately not true. But shout out to Claude Walker and Mark Tobin, who were longtime fans of Energy One. I remember not buying this company in about 2017 when it was 43 cents and it's now $14.
43 cents.
Yeah. So younger Owen has learned some things and turned into
Buy
everything today. Basically, GARP. So this is a wonderful business. I don't talk about it much on the podcast just because it's very illiquid. It's really held internally. It's ASX EOL is the ticker symbol for people that want to go and research it. It's a wonderful software business that does services. We've actually put out an article for this inside Rask Core if anyone's interested, or if you're a Rask investor, you can read the research. Wonderful business, really crazy share price movement recently. It's doubled in the past year. But it does energy.
Solid chart.
It does energy software. So retail, it also does the managed services. So it can actually put its people in with its software to run it for you, which is quite powerful. So it's got that great combination. Scaling up, there's few wrinkles on it, but that's a wonderful business. So there's another way to play that theme directly with the software and energy. What else?
Well, I know you've been looking at different offices and moving offices. I thought it was interesting where our lease comes up in about just over 12 months as well, about 18 months.
Oh, right.
And
the penthouse. What's Viewdemont got to do with that?
Someone commented this week that, those birds come back at the same time every day. Birds live in the roof, yeah. It's not all glamorous. You stayed in there too, come on.
Oh, yeah, no, it's lovely.
I thought it was interesting. So we're looking, like you're starting to meet real estate agents and understanding what's happening in the market there. And I was like interested to see that vacancy is something like 18% in offices in Melbourne at the moment. Other CBDs is like 13.5%. But traditionally, like in the last 25 years, we would have been used to seeing like 98.9% vacancy. Like
Maybe you mean
1% vacancy.
Yeah. So you're saying that it's higher than you thought?
It's I mean, like 20% of it's basically saying close to 20% of offices in Melbourne are empty.
Yeah, it's been a real eye opener dealing with leases for anyone that isn't in this space. It's a really weird exchange. I think the commercial property scene hasn't adjusted to actually having to sell stuff. Like they're just like, no, this is the lease. And you're like, yeah, but that's stupid. So I ain't going to pay that. And no one's been through here in 6 months. Yeah. So I'm just going to walk away now. And they're like,
depends who the owner
okay,
is. This is the problem. Like if you're a SMSF and that's your only asset is this level of an office building, you're not given much. But then like you look around at the moment and incentives are like 40 to 50% in some cases.
Can you put that in layman's terms for people?
Not really. It's really confusing. But basically the benefit you'll get, so if you sign a lease that is $100,000 a year, you're going to get, for 5 years, you're going to get like 40% of that back in some way or another, whether it's lease discounts or whether they pay for your fit out or something of that description.
Podcast studio.
Yeah. So what it means is the rent at the top level looks great still.
Still looks like the 100,000 or whatever it was. Vacancy
reduces. Yep, that's the right way. But your actual incoming cash flow is 30 to 40% smaller than it was before, or you're having to put more money back into it to get the same level of rent.
It's like everyone that thinks they've invented negative gearing should go and take a lesson out of commercial property because this is at scale. So I'll just give another definition just in case that wasn't. No, I think you did good. So I think you're perfect. That example was perfect. An incentive is usually can be expressed as dollars or percent, but the number one thing, like in residential property, is that the person that owns that office wants the value of the office to go up more than they want the income that comes from the office, which sounds kind of weird. Wouldn't you want both? They want their valuation to stay as high as possible so that when they go and sell it in the future, it stays up.
And also for their debt.
Yes, for their debt and also for the net asset value of their REIT.
Yeah.
Or if you're an Australian super fund and you own a lot of commercial property here in Melbourne, you don't really care because no one's cashing in for another 30 years.
They're not allowed to. Yeah.
So what we'll do is we'll just revalue the thing higher and higher and higher and higher. And everyone in a balanced strategy goes, look at my balance. It's going up. Because you don't need the income. You just need the thing to go up. So when you talk about vacancy rates, I immediately think, it's because all of these gigantic super funds and pension funds are just like, we'll have that building.
Yeah.
What does it make in income? It doesn't matter.
Well, that was the last kind of 15 years where they're getting billions and billions in every quarter. And if you're spending $800 million on an office tower, well, fine.
Yeah, whatever.
And it is a rounding error in a lot of cases at the bottom, but it does start to impact on your cap rate, which is the valuation rate of these properties. And you start to see it filter through. That's why REITs have struggled to come to rally as much as you'd expect them to.
Yeah.
But for comparison, I remember, I think our last lease in like 2015 or 16 was like a 10% incentive, if that.
Yeah.
And we had to pay for our own fit out.
Oh, wow, as well.
Yeah. So there was, 10 to 20% of the things kind of normal, 40% is significant.
So when you look at REITs, ladies and gentlemen, you want to get that distribution yield, but one of the things you've also got to, we don't have to go too deep into it, but you want like high occupancy, you want A-grade properties, what they call A-grade, they all say they're A-grade, but you want actual A-grade properties because the difference between A-grade and B-grade is not like seniors and reserves in your local footy club. It's like seniors in the Premier Division and
don't say a suburb.
Backyard footy and Shepparton. The Shepparton's probably got a really good footy club, actually.
Yeah,
they would.
They won't like
Shepparton,
you after
Victoria.
that.
Jesus.
But I was going to pull up, so Dexus is one of the biggest office
Charter
landlords.
Hall, GPT Group, yep.
And so what you want to look at is the net tangible asset value whenever we're looking at buying
It's the value of all the properties.
combined, less any debt. So the net tangible asset value of Dexus is $8.81 as of 31 December 2024. It's their most recent. They're sure they've got a new one coming out soon. And the share price is under $7. So basically it's saying you can buy the assets as they're currently valued of Dexus at a 25% discount to what we've valued them at as a company, which tells you two things. Either the value of those assets is going to come down or you're getting a discount.
Yeah. So a lot of people
Sometimes
don't trust
both.
A lot of people don't trust that the valuations are always a 100% reflection of the actual value.
And they were saying that, sorry, I've got the sheet up here, that their vacancy is actually, this is what triggered it because it's one of the holdings we've had. Their vacancy, these things are really long. Their office vacancy is only 93 only. His occupancy is 93.5, and that's significantly better than the market average of about 86 is what they were saying. It's mainly CBDs, and they are, I think Texas is pretty much A grade for a lot of it. Rent collections are 99.6, probably because rent isn't as high as it was before. And gearing 31%.
That's pretty good. 31% is good, right? So it's really, really interesting because if you go into warehouse and you go into industrial, that type of scene of commercial property is really tightly held right now. Yeah. It's mainly the office that's struggling.
Yeah. But it doesn't, like you go down, I'll probably annoy people with this, you go down to like South Wharf and that part of the city at the moment, and a lot of the big businesses that took space there have reduced their space, reduced their headcount, or have more flexible working arrangements, and they're struggling to release them.
And it's a bit of a sad reality, but I think if you're looking for property, now's a good time. I was chatting, just when we were looking at our office spaces and stuff, chatting to some of the real estate agents around, and even in Sydney and other parts of Brisbane, around not just Eastern Seaboard either, they were saying everything was looking really positive for the commercial office for the office space until Trump started announcing tariffs, because foreign wealth funds, like imagine superannuation funds from Europe or America or Asia, they buy Australian property for the income and the reliability. But as soon as there was the threat of tariffs, they're like, well, what's going to happen to the Australian currency? Like, will the Australian peso fall? Will it go up? Who knows, right? Yeah. Will I be taxed? Will I be taxed more? These types of things. And so I think a big part of that is like, we have really good property. We don't have enough demand to fill the properties. Very risky, I would say, entering leases, by the way. Final thing I'll say on this before I bore people to death. What else you got?
I just noticed looking live, Platinum and L1 have announced binding merger terms.
Really?
Yeah.
So this is good news for your bet, because you said that Platinum was the
share price went up.
Play of the year. Didn't you say something like
Platinum shareholders will receive in-perimeter performance fees, will retain performance fees on L1 capital long short. Yeah, it hasn't been great.
It's got 11% yield though.
Yeah.
Down 51% for the year, Platinum Asset Management, one of the Australians' funds management businesses. Drew and I have had, this is the second time Drew's gone around with this. So the first bet was that I took Magellan, Drew would take Platinum, that I said Magellan would do better. Then Drew did double or nothing, and it's since fallen another 51%. Meanwhile, Magellan is up 3%. Man,
sometimes you just got to hang on there and you'll be fine. Really? It's not even up today. So it's a merge. Platinum's acquiring L1 technically, and then issuing Platinum shares to L1 shareholders. Must be because L1's not listed, but all their funds are listed. So Platinum then becomes L1.
What do you get if you buy a funds management business?
What do you get? So inherent performance fees. You get assets under management, and you get the rights to continue to charge fees on that assets under management, and then any performance fees, which is a part of this deal. But they have said they'll be carved off to different shareholders. Performance fees accrued in previous periods will be for Platinum, and the other one for L1.
So
you get the people.
So you get the people and you get the customers.
Yeah, the assets, but they're not sticky. They don't have to be sticky assets. I mean, Platinum's a perfect example with billions of outflows in the last 10 years.
Yeah, right. It's interesting because
It's just a revenue
if
stream.
L1 could turn the platinum business around, then they've got a stable base and they can give a kind of new lease on life to the customers.
It's still a value manager.
Yeah.
Can you turn platinum into a non-value manager?
Buy, hold, sell. Platinum Asset Management shares today. PTM is a ticker symbol.
Sell. Sell. I said
Sell.
that very quietly.
Sell. Okay. Buy, hold, sell. Magellan Financial Group.
Sell.
Buy, hold, sell. Pinnacle PNI.
Oh, that thing just seems to always go up.
So buy.
Buy.
Buy, hold, sell. GQG.
Sell.
Really?
GQG's underperforming at the moment.
Okay. Final one. Buy, hold, sell. Goldman Sachs.
Buy.
Damn, that thing just doesn't fail, does it? Doesn't fail.
Always back investment bankers. I was saying, so just from Morgan Stanley said that the Kraken deal I was just talking about would add $2 a share to Origin alone.
Oh, right. Okay, so that's pretty good value. Buy, hold, sell. Macquarie Group.
Buy.
What basis?
It's an investment bank.
So any investment
Goldman
bank.
Sachs.
So
If
Goldman
another
Sachs
company's
is
going
up.
to get to $1 trillion in Australia, it's Macquarie.
Macquarie's up. Give me another investment bank.
Globally, JP Morgan. I mean, they're a bit more customer.
Yeah, let's have a look.
Citi.
That's not in the ASX. All right, JP Morgan. Buy, hold, sell.
So,
Holy macaroni. It is absolutely
looked like KKR looked
flying. Wow.
Before the issues earlier this year.
Wow. KKR, buy, hold, sell.
I reckon I would buy.
What is that? Okay, yeah.
It's doing a head and shoulders pattern.
It's got a bit of a head and shoulders pattern.
Yeah.
The reverse candlestick's looking pretty good though.
Yeah.
Okay. Well, I don't know of any others off the top of my head. So, all right. Would you rather buy KKR or Macquarie?
At current value, KKR.
KKR is a $120 billion company for those playing along.
On a 58 times PE.
It's an investment bank that does not investment. It's more private equity, whereas Macquarie obviously does retail banking and investment banking. It's an $88 billion company, so slightly smaller. I'd probably take Macquarie.
Yeah. Is this another bet?
We can do that. Yeah. So let's put this down. I'll take Macquarie and you'll take, so write this down.
KKR.
Okay. So Owen takes Macquarie, you take KKR. Over 1 year?
I mean, every time I do this, it doesn't work out well. So
I think that KKR is a good business. I just think Macquarie's better.
I'll probably lose everything, but win the portfolio.
Oh,
Elon Musk will oust Trump at the end of the year on some technicality and become president. And then he'll buy all Tesla cars or something like that. And that'll be on 29th of December. And I'll
watch
win.
G-Gus rally, mate. I'm just saying G-Gus is coming back because that's in my portfolio, ladies and gentlemen.
S&P just hit an all-time high. So if it hasn't rallied yet, it may not rally.
Okay, I've got time for a couple more questions.
You didn't equal weighted. That's your problem, isn't it?
Well, the reason I did equal weighted is to illustrate the value of G-Gus and just having simplicity in a portfolio, whereas you did like a science-based thing. Well, yeah, because you can add 2 times leverage. So effectively, it's a double weight position. So I get $11 for $10.
To the company. If you just had the S&P 500, you would have done better.
Well,
now I sound like Warren Buffett.
James in our team pointed this out to me the other day. What do you think G-Gus, which is the leveraged US stock market ETF, what do you think G-Gus has returned over 3 years?
16%.
So over 3 years, G-Gus has returned 27% per annum.
Solid.
Over 5 years, it's compounded at 23% per annum. Look at that.
Which one's the chart? Is it the orange one?
Yeah. I mean, you've been to hospital 4 times since you've been holding this thing.
I'm tired just looking at that.
But now this is my next question.
Just to everyone, it rallies hard and then it falls hard back to the index and then rallies hard and then falls hard.
Yeah. Volatility decay. What? 23% per annum over 5 years is what G-Gus, the leveraged ETF from Beta Shares, has done. What has FANG done? Your mate.
33%.
33%. So you're saying FANG's better on 5-year basis.
What's the biggest holding of G-Gus? They're still going to have Microsoft, Apple, and all of those, but equal weighted.
3 years, FANG has done 46.5%
I told you.
per annum.
Yeah.
Over 5 years, 30% per annum.
Mine's equal weighted too.
Holy macaroni.
Semi-equal weighted. But what are the top holdings in? You're not going to see them because they're all going to be equally weighted. So
In GGAS?
Yeah, you're just losing, and this is fine. Like, you're not losing.
I don't actually.
You're getting more diversification, but you're losing the concentration that's driven returns for the last 5 years.
GGAS, most recent update, Apple 6.7%, Microsoft 6.2%, Nvidia, Amazon, Meta's at 2.5%, and then Berkshire's fifth at 2.1%. So it's just the S&P 500.
Yeah.
Leveraged to the hilt, bro.
It's not equal weighted.
No, this is market cap weighted, isn't it? Are you thinking the QUS?
Maybe I was, yeah.
My portfolio is equal weighted.
Yeah.
But
that makes sense, yeah.
This is leveraged.
So why is it doing better?
Than what?
Than me.
No, Fang's doing better.
Yeah.
Fang's doing a lot better.
Yeah, but you should be doing better than my portfolio. The S&P just hit an all-time high.
Yeah, but it's over 500 names. Fang's got all of the gains, man. Over the last 3 or 4 years, like the Mag 7's added basically all the value of the S&P 500. So you're actually diluting your exposure by having this.
Yeah, but gaining diversification.
Well, yeah, but I don't know.
With real money. If you're using real money, you might think about equal weighting to get diversification.
James in our team suggested that you don't need to use gearing when you're using this type of strategy because you could just have Fang.
Yeah.
Because it's so leveraged.
Yeah.
Because you swap the gearing for the concentration.
Yeah.
Which I get, but no one,
Each their own.
Yeah. Have a bit of fun.
Yeah.
Okay, we've got time for 2 quick questions. Just, you can send your questions in via the link in the podcast player. We should have done more questions today. We do love questions. We love a bit of banter thanks to Rowan Rask before with that tongue twister. But we do have a few quick questions, and if we do answer them, they're general in nature only. If your question sounds too personal or like a planted question from a spy, we just probably won't answer it. And I don't mean offense to that. It's just that we have to be very careful because before you act on any of the information you hear in this podcast, you should consult a licensed and trusted financial planner so that they can take into account your needs, goals, and objectives. If we talk about ETFs or super funds, those come with something called a PDS or product disclosure statement. Be sure to read them, and definitely don't change super funds based solely on what you hear in a podcast. So this first question was about just a real quick one. The abbreviation nation featuring MCGG, EFT, LIC, and EOFY. Unfortunately for the abbreviation nation who wrote into us, they did say EFT instead of ETF.
Sometimes in their defense, sometimes Grammarly steps in and they're there.
Autocorrect.
I always get there. I'm like, that's not the there I wanted. Then you change it and rechange. Sorry. I sound like
EOFY EFT question. I noticed this morning on July 1st that one of my ETFs, MCGG,
Munro Concentrated Global Growth Fund.
Thank you. Is down 15%. I'm presuming this is to do with fees, and especially with performance fees being basically a lick, but a little explanation on how this works would be amazing. My position has basically gone from positive 12% to now negative 3%. Love the show, and thanks for keeping me sane while driving day to day. I mean, that last part is dubious. Do we keep it sane? But in all seriousness, the abbreviation nation, why is this happening, Drew?
We get this question every year, even for clients that have been with us for 15 or 20 years. I got a text message on the 3rd of July as well.
Yep.
Why did my portfolio drop 15% yesterday?
Yeah.
So MCGG is an ETF. An ETF is structured as a unit trust. And as a trust, it must distribute all capital gains and all income that is generated every year. So if Munro, Nick Griffin's out there selling Nvidia, buying stuff and turning it over, he's going to realize a capital gain. And he's also got dividends, and he's also might have some proceeds from takeovers. So what that means is as of the end of financial year, all of that gain has to be paid out if there aren't any losses in there. And he probably doesn't have any losses, he's been doing that well. So in the case of Munro, and this is the same for all ETFs, it's different for LICs. Maybe you can do LICs. But this trust had a unit price of $16.95 on the 30th of June. Mm-hmm. On the 1st of July, it fell to $14.06. But it announced or declared a distribution of $2.53 per unit. Quite a large distribution. No, and obviously the big chunk of that's going to be capital gains. But what happens is it's similar to when a company goes ex-dividend, no different. So if a company goes ex-dividend, the share price falls on the day it goes ex-dividend, but you don't receive that dividend for usually 4 to 6 weeks. So what happens here is you've gone ex-distribution, so that capital is being returned, and within the next 2 weeks, give or take, you're going to receive $2.50 per share in your bank account.
Yep.
That's why it drops. It's exactly the same as any other share. But I don't think it's unique to managed funds in the fact, and managed funds ETFs, because it's usually so significant. When it's been a good year and there's been turnover, it's not 2 or 3%, it's 5, 10, 15%.
Yeah. Most active funds that are good have the same problem because they make money and the profits then need to be sent back to you. You can just turn on a dividend reinvestment plan or a distribution reinvestment plan. Some brokers, like say Pearler, you don't need to turn on the DRP. Once the cash hits your bank account, you can automate it so it can send back in.
Yeah.
But you can see here on the screen in front of you the Lakehouse Global Growth Active ETF, which we own. We got the same question from many people in the community. So Abbreviation Nation.
Is that percentage?
Don't worry about what you see. Big drop-offs from time to time, and that is perfectly fine. Just make sure that you have that dividend reinvestment plan turned back on, or that you're ensuring that you understand that you don't panic when this happens. Another reason that we can see big share price falls, and you should always check before acting, sometimes companies can do a share split and the brokers don't pick up on that. So your company or your ETF might go from $100 share price to $25 share price. The gold ETF did that. And people were like, oh my God, I'm down 75%. No, you've just got 4 more ETF units than you had before. So it's just split up. Really important to understand that you just don't freak out. You ask the question first. Final question here. This is a fascinating question for you, Drew. I'm just going to throw this at you. I just want to make sure I know who it's been sent from. Chet writes in and says, with interest rates going down, I have 2,000 AUD kept apart from emergency, which I want to invest in a safe short-term option where I can get more under, they're saying under 5%, but low risk. What do you suggest? Or should I be looking at a beta shares conservative portfolio? Now, I want to be very careful with this question. Any investments, when you hear a question like this, what do you think?
You're saying safe short-term option?
Yep. Which is?
My first question is, what do you need? What do you need the money for? Mm-hmm. If it's only a short-term option, is it going to go back in your emergency account?
Yep.
And my first, I'm very conservative by default, which is like, we'll just hold it in cash or a term deposit. Mm-hmm. But it's what's the purpose of this money?
Yeah.
Before you start thinking about the outcome at the end.
Safety first.
Yeah.
Yeah. There's a general rule of thumb is 6 months of, if 6 months of cash in an emergency fund, up to 2 years, maybe if you're a retiree. So you know you've got that parked aside and that just goes in savings. I do have a question for you. And this is, I'm going to catch you off guard here. All and right. It's literally just come in in the last couple of minutes. In fact, while we've been talking, this is from my wife's dead cat.
Maybe didn't have to lead with that.
What's the catch with low-cost SMSF providers like Stake or eSuperFund, Drew?
What's the catch?
Yeah.
Well, usually, I'm not saying these two specific ones, but usually you're paying for something somewhere. Like there's a basic cost of delivering an SMSF tax return, and if you're not, if it's lower than that cost, then there's some sort of relationship. I don't know for these two in particular, but historically there were things like there's a group called, we could probably talk about, Dixon's, not comparing either of these two to Dixon's, let's be incredibly clear, where the tax returns were cheap, but the investments were blah, blah, blah. We don't have to go into too much detail about that.
Yeah.
But suffice to say, they were making money in different ways. How it's happened in SMSFs before, probably similar to a platform like NetWealth Hub24, where they might have an agreement that you use a certain bank account. And then the bank account pays you 4, but they take 2. Like that's usually where these things happen.
Yeah.
That it's not actually that low cost. You're missing out somewhere else.
Yeah, I think that they've just basically, my opinion of this is they just take a lot of technology and use that for the administration, which often costs with the self-managed super fund.
Yeah.
The way I see it today, there's no benefit of a self-managed super fund these days unless you're using the self-managed super fund to buy physical assets.
Yeah, which if you talk to, listen to last week's podcast.
Yeah, like property or whatever. Actually, James...
Your business premises.
James, Drew and I, James joined us from the retirement podcast that he does with Drew.
Is he going to come back?
Well, I copped so many things about that. So James basically come on and proved with math.
With math.
With math.
Math's been debunked.
He did a proof.
Math's been debunked.
Fake news. He came on and basically said, never buy property through a self-managed super fund, which is so, I think that's so right in so many ways. There are so many spruikers out there. It is unbelievable. I dealt with a few more, I would say, quote unquote, victims in the last week.
It was based on math though.
But this is the thing. It wasn't it was based on real math. And a lot of people have reached out to me asking for the spreadsheet. And there's another one here from What's a Matter You that sent in a question today as well. Is there an updated Northeast Google Sheet? We will make that available in this episode's description so you can access that. I'm not 100% sure if the team put it out with the other one. So I'll just leave a note for myself, Northeast spreadsheet. But we've talked a lot about property lately. SMSFs, the reason why I say you don't necessarily need them as much anymore is because you can just use one of the platforms that offers super, like Perla does it, who's a sponsor of our finance podcast for accumulators. Vanguard does it. You can use NetWealth to do it. You don't need to have an SMSF. No. You can just have an account that is for an for a superannuation fund. We're not saying go and do that, but just that is an option. Self-managed super funds make sense for business owners and for people that want real assets.
It's changed so much in the last 3, 4, 5 years.
Yeah.
Like platforms offer cybersecurity protection, the ability to invest overseas, domestically,
managed
all kinds
funds,
of asset
private
classes.
credit, that, whatever you want.
And some protection. And now historically, every single person that came in wanted an SMSF. And now most of what they want, we can deliver in a platform. And with a relationship we built, we can actually get quite a capped cost on it, which makes it incredibly cost effective if you just want control and transparency over traditional and most traditional investments.
Yeah.
There's a bit of vitriol on the old YouTube video.
Is there?
Yeah.
Is there a good one there?
Bit of clickbait here. Awesome pod. Thanks for the free membership. Can we please get a hard copy of James' Assumption? Oh no, there's a couple of Benjamin Follett on... James is incorrect. The so-called professionals in retail super funds get it wrong a lot. I have invested in property. I'm doing a lot better than a retail super fund. Nice of you to make James a shirt from your curtains. I like this green linen shirt. It was actually a really nice linen shirt.
What was that? What did they say?
Leverage and decade compounding will always win. Bit of clickbait here. Oh. But what do I do now? I'm a dog with property and super. No, he said, so nice of you to make James a shirt from your curtains. But I really liked his green linen shirt. It was great, olive. What your choice of curtains.
What are you wearing today, by the way?
It's called a shacket. It's kind of for that transitional period. So half shirt, half jacket. It's quite,
Transitional period to what?
You wouldn't know that fashion. It's like...
Oh my gosh.
All right, hopefully no one's listening at this point of the episode.
Anyway, so James' spreadsheet will be available.
Job of the day.
Which is the dad joke. Yeah. But before you get to that, special shout out to Equity Mates. Equity Mates announced in the last week that they formed an agreement to be acquired by BetaShares. So pretty close to home for me. Love the guys at Equity Mates, and I think they've done a great job with their podcasting community. And BetaShares is obviously a powerhouse in ETFs and funds management generally and the way it's going. So huge shout out to Bryce and Ren, and hope you do great things over there at BetaShares in years to come. So that's a quick little shout out there. Drew, you've got to leave us with the dad joke. Anyone that wrote in a joke / question this week, you can send us a...
if you're on YouTube, come get a free
message.
Book.
Send us a message via the Rask websites, and we'll get you a Rask Core membership, and you may also get one of Drew's books, which were available at Sydney Dimick's 2 for 1, I believe, or something like that, or 50% off the next book.
We should just do an episode where we read out the YouTube comments from both of our channels. It'll be a bonus episode.
I still think what was wrong with James' shirt?
There was nothing wrong. I think it was more your curtains that are the problem. They're not green when you're in here, but on the video they look green.
Oh, wow.
Yeah.
Well, fix that in the new office. There's another 3 years worth of lease payments. All right, give us a dad joke, Drew, from Waddle Partners.
Stop looking for the perfect match. Mm-hmm. Use a lighter.
Smooth, mate. I'm sure the kids will love that one. That's a pretty good one. If you want to get in touch here with Drew, I don't know why anyone would want to get in touch with us after today's, but if you want to get in touch with Drew and the team at Wattle Partners, do fantastic financial advice over at wattlepartners.com.au. You can also follow the link in your podcast player in the description, where you will also find a link to send us a question, just like the Australian Investors Podcast. If you're into retirement or you just think it's inevitable, head over to the Australian Retirement Podcast, where you can get more of James's green shirt and also Drew here with his shacket. We would love to have you subscribe to the show if you already listen regularly and you haven't done that yet. We would love for you to do that. Same if you just want to send us a message or just have a bit of a chat with us in real time, jump into the Rask community at community.rask.com.au. It's totally free. Drew, absolute pleasure. Thanks for joining me.
It's good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.